Good afternoon, investors, and welcome to our February 27th, 2024 edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing and one of the sponsors of these type of webcast editions. My colleague Ken Kavula is traveling and probably headed for a square that looks a lot like the one in the picture in the neighborhoods of Savannah, Georgia, which has some really neat neighborhoods to explore. So Ken and Natalie are on their way to do that. And this afternoon, I'm joined by our two regular special guests, Matt Spielman from Houston. Good afternoon, Matt.
Good afternoon, Mark.
And Kim Butcher from Florida has begun to rejoin us on a more frequent basis, but the jackhammers are still there.
Welcome, everybody.
She is continuing on her construction, what's actually the construction projects at her building, but those are ongoing. And we have a very special guest with us here today as a co-host, my friend Ken Williams. Ken Williams he hails from the same vicinity as Kevin Gologly, specifically the Washington, D.C. and Maryland area. And Ken has been a part of investment club efforts, the National Association of Investors, and correct me if I'm wrong, Ken, but also the American Association, as I remember from a few years ago. Welcome, Ken.
Yes, I'm a lifetime member both organizations, so yes.
Because didn't I visit, weren't you behind getting me out to a AAII meeting like 10 or 15 years ago?
Yeah, that was at a time when we were doing joint programs between both our Better Investing chapter and AAII. But yeah.
Cool. Well, it's been good knowing you all these years. Look forward to hearing your thoughts on compounding machines. And that's what the entry up on the upper right of the screen is all about. He's going to share some of the work that he has observed from a gentleman by the name of Joseph Carlson, which we have found most interesting. We're going to talk a little bit about Noah's Ark investing. Going to follow up on our sell discipline comments from last week's dissertation on Ben Carlson's, the other Carlson commentary. We're not going to do anything with Buttonwood other than to tell you how it's doing, and we'll be back to tinkering with that most likely at next week's session or the one after that. So with that, we will get underway. Here's our weekly reminder that Portillo's is not a sponsor of this session, but they should be. And this picture was provided by Fred Tunnies of St. Louis. He's one of the leaders in investment education for the St. Louis chapter of the National Association of Investors. And he went out doing some field research. And he actually says they actually give you that tag to put on your chest as you leave there, that you have visited Portillo's for the first time. And good stuff. Speaking of good stuff, Portillo's reported their quarterly results this morning. And I'll just say they were apparently delicious. The stock price is up 16% today. And and we like that. So who knows? Kim, keep working on getting them to sponsor our webcasts. Or throw in a hot dog or two.
Well, do I need to tell everyone the background on that?
Let's save it. Let's save it for later because Kim has a backstory ready to erupt at any time. So we've got a pretty full plate here today, but we'll go for it at some point right down the road, especially after we get a little more detail. Here's our standard disclaimer. No investment recommendation is intended. This is an educational demonstration. Everything that we do here at Bull Sessions is intended to illustrate and demonstrate the methods, techniques, and philosophies of the modern investment club movement and to share things that we have learned from 8 decades of successful investing. So we think some pretty solid approaches to investing, the discovery of companies and the design and management of portfolios is worth noting, and we like to share the lessons that we have learned. If we own something like Kim and I obviously own PTLOs. If we own something, we'll try to remember to disclose that along the way. And we think it's up to you to form your own opinions, make your own decisions about investing related resources. We're not the boss of you. Our roundtable is not tonight. It's a week from today. And it's our annual black tie and red carpet celebration where we look back on the selections we've made over the last year and all time. And we look forward to that. If you'd like to be added to the reminder list about those monthly webcasts, and we'll have a slide which goes over this here as we go through, but for the reminder list, send an email to nkavula1@comcast.net if you'd like to be added to that reminder list. Again, you're just going to get a couple of emails reminding you that that particular monthly webcast is coming up. If you have any questions about any of this stuff, or if you have suggestions about future topics, please send an email to markr@manifestinvesting.com or kkavula1@comcast.net. Any other comments, Kim or Matt or Ken? You guys are all good.
So let's go.
Let's
We're
go.
good. We just have to start looking at picking a stock for next week.
Okay. Well, they're starting to come in.
Mhm.
Here's our look at our weekly look at the market as measured by the value line arithmetic index. That's what the green bars are. You can see they continue to be right there hovering around 10,000. Our purpose in doing this is to compare those zigging and zagging lines, which represent, the yellow one is the value line median appreciation projection. The way that you might want to think of that is, what if you did a stock selection guide on all 1,700 companies in the value line investment survey and basically came up with a median or an average? And that's basically what you're looking at there. So that's the average stock study, courtesy of value line by the green bar. The only thing missing from that is dividend yield, by the way. So over time, you can see that they definitely fluctuate along with stock prices. The red is the manifest investing projected annual return. Again, that is the median return forecast of we're actually now at about 2,600 companies that we cover. And you can see that the two forecasts definitely resemble each other. The specific forecast as of today is approximately 10%. According to those measures. Anytime that the green bars are below the blue line, shop even more earnestly than usual. Always be selective, but shop more with more fervor than usual. Any comments on this or questions? You guys are awfully quiet today. You just want to get to the Ken Williams presentation, and we will do that. But first, let's stop and talk about a feature that we have covered for a while, Value Line. They actually hold a webcast of their own where they pick and feature a stock once a month. They most recently did it on February 22nd. And Kim, they picked PayPal. So they see the type of promise that you do. You can, or Kim, you've actually selected PayPal a number of times for the roundtable. What are your thoughts from 35,000 feet on PayPal?
They have a great network effect, and they have a new CEO in town, and he's done what he said he was going to do. He's changed a lot of the management to get rid of the old under Dan before. He's been buying back shares. He's increasing their network effect. Gonna have to give him an opportunity to do what he said he's gonna do, and they've got a lot of cash on the balance sheet. They've got the best, as I feel. They're more international and have more merchants than a lot of the others, so I feel it's going to do well. Value Line, if you want to circle a few things, I don't know if you can.
I can.
Okay, look at the projection box.
Yeah, good point.
to see the low of 23 and the high of 36 for annual return. I like a minimum of 10. It has to be 10 if I'm interested. Well, that 23 is even better. I'm not complaining. If you look at the PE ratio at the top, Mark, it's below the trailing at 16.6, and look where they think it's going to go out in the future at 30. What happens when we have PE expansion? Stock price goes up. Cha-ching. I always would trying to understand when they say Buffett would just sit and have value line sheets and just flip them. But look how you're going to have these profit margins go from 12.9 to 17. That's just visually a few things just to see real quick. And the last one for me is the very center of the chart, Mark, where you have the dotted lines. The dotted line in the middle is where they think the stock price is going to go. The black dot at the bottom down there is the stock price right now. And if you have an annual return of 23 to 36%, the dotted lines on the far right-hand side, meaning it's going to go up to like 145 to 220, it says that's how much they feel the potential is for this stock to go up in price. These are just a few things visually. You look at it and you say, okay, we got an undervalued stock here. Let's, do our little bit more research. I'd like to check what's not going to have on here is going to be every manager and every insider is going to be motivated by what their compensation is. So I always go to the 14As, which is a proxy, and find out what metrics do they have to meet so they get paid and get their bonuses.
Cool.
So in doing all that, I think I've shown you 5 things here of where the stock is undervalued. Then do a little bit more research, and just like any other investor, you find a stock that you think is undervalued, then you sit on your hands and wait to see if it plays out how you think. So.
Well, there you go. Well, Value Line obviously shares some of the same thoughts. You can actually find these presentations by going to YouTube. You can just search on what you see right here, and you'll see the series. So you can take a look at what their thoughts are on PayPal also. I would also point out that it's one of the most frequently chosen stocks by our Groundhog participants this year. So here's a quick look at how the Value Line selections have done over the last almost 3 years now. And they've had some mixed results, but pretty decent in general. If they could do like the Olympics and the Russian judge and throw out a couple of that they've done along the way, it would be really, really good. I don't know. We'll spend some more time talking about this in the future. I think if they paid a little more careful attention to growth forecasts and quality, some of these numbers could be improved. Might have skipped a couple of those along the way. If you look at them just pretty quickly, top to bottom, some of the better performing selections are the higher quality ones with higher growth rates. So we'll continue to take a look at that. Another quick tidbit of news, nugget, or whatever you want to call it. Apparently Goldman Sachs has come up with a competitor to the Magnificent Seven. And I don't know, maybe we'll take a straw poll here. How many of you guys think this is going to catch on? Granola. I just have this image of a stack of Scrabble tiles trying to put together words along with groups of stocks. This happens to be a group of stocks in Europe that have done fairly well of late, but I'm just having a hard time developing an appetite for this granola. I don't know. Some good
It could be
companies
granola. It could catch on in Europe, but in Europe it'd be muesli, so it's a whole different word.
Then they'd have to go find different companies to backfit it.
Yeah.
No, this is a good list of companies, though. Great list of companies, and some of them a little bit better than others from our perspective, but there's some pretty good ones on there. The other thing that I noticed here, and Matt and I were talking about this before we got underway, if you look at those growth rates for year over year sales for 24 versus 23, the recession's not completely over in Europe, and some of those are a bit challenged by economic conditions, and they continue to be. So that continues to be disruptive.
Yeah, it's really interesting how not dominated by NSA tech, because there is a lot of pharma in here, but computer tech companies this is, and I don't yet know, but I bet it speaks somewhat to where the market in Europe really is. So these are sort of they are concentrated still, a lot of luxury names, a lot of pharma names, but whole different areas.
Yeah, more pharma content that we see in many places, but some awfully good pharma content for sure. And of course, SAP has been a supporter of investment club stuff for many, many years. And
also a software company migrating to the cloud. You don't hear about it unless you deal in corporate IT, but as much of a cloud migration story, not quite as high as Adobe, because they can't make their legacy customers go, but certainly they've pushed that hard.
yeah, and they do some great work over the years, so good stuff. And then another side point, just to note, many of you are familiar with the Ardelic story. We're not going to go into that now, but this is one of the theorized companies that might actually acquire Ardelics, so AstraZeneca. So keep your eyes open on that. Here's our Twitter moment for the week. I just found this to be kind of interesting. This guy, Daniel Kin, I think that's how you say his name, basically pointed out these powerful duopolies. And I was taken back to my early days with the Chicago chapter, with the National Association, and Quentin Sampson was the president back in that time frame. And he had a portfolio. We used to tease him about, owning Pepsi and Coca-Cola in the same personal portfolio. And he referred to his portfolio as a Noah's Ark portfolio. Some people have actually done presentations on you don't want to do that. This actually runs kind of counter to that. I know a number of people that, for example, own these two companies, Visa and MasterCard, and some even are not afraid to avoid the taste test and own Pepsi and Coca-Cola. We talked about Thermo Fisher here a couple of weeks ago, and actually selected it for the Buttonwood portfolio. So it's an interesting list. And Kim, that one up at the top there is one of your longtime favorites.
Yeah, I had to unmute myself. Yeah, S&P is my happy dance stock because it was a spinoff.
And you've had that for a long time, right?
Ever since it spun off at like $49 and it's 400 and something now.
Well, that's a cha-ching for sure.
Uh-huh.
And we actually own both Lilly and Novo for different reasons. And before they became involved in the current obesity medication contest. So from even before that. So good stuff all around. Any other thoughts on this?
No, certainly a number of these show up in Joseph Carlson's portfolio too.
Yeah, and what's kind of funny, I was telling Ken before we got underway, is I put this slide together before reviewing any of Carlson's stuff. It's not going to be believable once you see some of the stuff that Ken's going to talk about, but there you have it. For a little bit of perspective, here's our weekly look at how this stuff stacks up versus history and some comparisons. And what I did is I took the 14 companies, so any place where you see one of those companies, and took a look at their trailing, it's actually 9.9 year, if you want to get picky, but a 10-year trailing return for these 14 companies versus some of these market benchmarks, including the one we use most commonly is the Wilshire 5000 for the general stock market. And again, this just amplifies that notion that the value line, which usually is higher than the Wilshire 5000, is actually checking in below it. And with these two guys down here over the last 10 years, to me, it just says no different than we've talked about for the last 6 months. This is kind of like a coiled spring because those mid caps and small cap companies in general do pretty well in this performance stack down at the bottom. So I think of them as a coiled spring, but you can see these aren't messing around. Those are some pretty significant returns, including Kim's S&P Global right up there near the top. So there is something to this when you stack up all 14 and you get a relative return of approximately 8% versus a trailing return of 20. That's some pretty good stuff. So maybe there is a bit of a nudge, and that actually kind of leads us into this notion of compounding machines, because I think many of these would qualify for the compounding machines we're going to hear about. Any other thoughts on this, gang?
Nope.
It's just
Okay.
I think that chart, Mark, is a prime example of why the membership of Manifest really needs to listen to when the roundtable presentations are done, because look at how well it's done.
Yeah, it's cranking away. In fact, it's 17.6 as of today. So 17.6 and some pretty powerful ideas over time. Good stuff. And the next one is 7 days away. All right, before we get started with Ken, here's our groundhog update. And again, about half of the participants are beating the Wilshire 5000. As shown here, the average is checking in at 2.5%. And they're starting to settle down a bit. We don't get quite the amount of bumpiness in the whole thing. Now, Kim, you've actually moved up to like 44th. And with the performance of our Delex today, probably even better. And again, a lot of new names. That Four Corners Investment Club is pretty formidable. Keith Tubbs is a member of Four Corners. So the number 1 is part of number 8. And I think some of his colleagues are on here too. I mean, Fritz at number 20, Renee at 21, and Melissa at 35. They're all in that club. So this is a clear and present danger for all of us groundhogs. Doing pretty well. Now, Ken Williams, I believe, are you a member of Happy Destiny and Montgomery County, Ken? Is that
Yes,
accurate?
I are in both clubs, and we decided to do a slightly different approach this year. In past, we would ask members to give their ideas for the groundhog portfolio, and that's kind of like how we would formulate a portfolio.
Uh-huh.
But this time, I just really try to encourage everyone to pick stocks from our own portfolio that were either in our holdings or on our watch list, and you can see that we're doing a whole lot better this year.
Interesting, because you've obviously heard Ken Cavola describe that as what we witnessed from a number of participating clubs in the area. And yeah, sticking with what you know, kind of picking from a vetted list, so to speak. So good stuff. And
Number 4 there, Will Mobley.
uh-huh.
It's really great because Ken Mobley I met at bank, and this is his son who just finished up college. So he's getting the next generation to do stock investing. So I think that's pretty exciting.
Yeah, I believe Will was the place kicker for his college football team,
Yeah.
if memory serves me right. So good stuff. And the picture on the right, just received it. It's actually a picture of last year's group champions. That's the principal members of the Orange County, California Model Club. And we'll probably hear more from them. They're in the mix, and they've won it 2 times in the last 4 years, so they are obviously always dangerous. Ken's not here, so we don't have to really worry about the monkey, but the monkey has dropped all the way to 78th. So Ken can sleep at night again. All right. So with that, let's go ahead and get underway. Again, Ken Williams. He's been in the investment education efforts out in the Washington, D.C. area and the Maryland chapter of the National Association. And as he said, a lifetime member of the American Association of Investors also. And has some thoughts to share with us on the work of Joseph Carlson and compounding machines. So welcome, Ken, to the program.
Thank you so much. This is a presentation that I recently presented to my club the Montgomery County Investment Club. So I recently did this education this past Wednesday when we met. Next slide. So Joseph Carlson is an individual that I've listened to for maybe 2 or 3 years, and he has a show on YouTube. And what I kind of find fascinating is from week to week he will discuss his portfolio. He'll show you what he's investing in, and whether it's up or down. He shows you what his portfolio is. He will talk about different items of interest that are going on in the market. He'll talk about investors that he's studying and kind of learning from. But that's kind of the nature of his show on YouTube. So it kind of inspired me to start my own dividend portfolio using M1 Finance, which is kind of what he's been using to manage the brokerage he's been using in managing his portfolio.
Well, you'll see that
Mhm.
as Ken continues with this, you'll see that his approach to investing is very, very compatible with what we do. So I'm just fascinated. Again, thanks for bringing him to our attention, Ken.
Sure. All right, so next slide here. So here are some of his influences. On the top row there, you'll see Bill Ackman and Chris Hahn. And then on the bottom row, you have Dev Kantesaria, Terry Smith. Of course, we're all familiar with Warren Buffett and Charlie Munger. And then there at the end is Chuck Ocker. And you may have heard about his three-legged stool method of investing. But these are all his influences, and from time to time he'll talk about what he's gathered from studying these investors, and there's some pretty interesting insights that he presents.
Yeah,
Next slide.
we've talked about
Go ahead.
many of these, but Terry Smith's emphasis on quality is one that was part of a series of presentations a little while back. But I suspect we're going to be learning a little bit more about Dev Kantesaria and maybe a quick look at the three-legged stool. Go ahead, Ken.
Okay. So the recent show that he did in January, he discussed his investment philosophy. So I really found this fascinating because he kind of distilled it in over the course of one show. But essentially his philosophy is buying, holding, and maintaining a portfolio of compounding machines with a disciplined long-term approach. And how he defines compounding machines are essentially companies that continue to increase their intrinsic value from year to year. And the three main focuses are finding exceedingly high quality companies through stock selection, maintaining the right temperament, and exercising prudent portfolio management. What I was most fascinated with was his approach to stock selection, and that's kind of what I shared with the club, or my club. Next slide. So with respect to compounding machines, he says that there are attractive attributes and then there are unattractive attributes. So there are approximately 6 attractive attributes that he defines, and there are 4 unattractive attributes. It would have been too much to go over all of them for my club meeting, so I decided to break my presentation up into 2 parts. So this first part, we're going to focus on the attractive attributes. Next slide. So with respect to the attractive attributes, they are monopoly, pricing power, operating leverage, organic growth, capital light, and smart capital allocation. And I think he lists them here in the order of importance. If you can find a company that has all of these attributes, then you have an exceptional company. But yeah, it's kind of rare to find companies that meet all of this criteria or attributes.
Yeah,
Next slide.
these are pretty powerful. I mean, I was, in a word, enchanted by some of what I encountered. I mean, the operating leverage that he's talking about, he's literally talking about up, straight, and parallel. Organic growth, same thing. You know, the power of that growth characteristic in our studies. Capital light, and he's really just referring to investing effectively and efficiently in the company's initiatives. And so all this stuff really it lines up pretty well. And on the manifest forum, we did include the links to all of the citations that you provided, Ken, so you can get to them there. And there are some excellent summaries for those that want to follow up. Go ahead, sir.
So the first attribute he discusses is monopoly, and how he describes it is it's a company that has a large market share in a concentrated industry. They tend to be they have entrenched distribution, brand name, install base, or a subscriber base, and then there tends to be high barriers to entry. So go ahead and go to the next slide there. We'll discuss the examples. So in his presentation, he talks about Alphabet. They have 92% market share of search. Visa and Visa and MasterCard is essentially a duopoly, which Mark made reference to in the previous slide there. Where they seem to have a digital payments duopoly. Then we have Netflix. They recently reached a $260 million customer subscriber base. I mean, their market is essentially planet Earth, with the exception of China and Russia. And then we have Adobe. That has 80% of their revenue through recurring subscriptions, and then they're deeply entrenched in college campuses and the workforce. Any comments?
No, other than to just observe how much these are aligning with the things that we talk about so much. In fact, Kevin Gologly was going to bring Netflix to the roundtable a few months ago. He should have. And Adobe is one of Matt's favorites, very powerful company. And of course, Google, somebody made the observation with all of this stuff that is being based on artificial intelligence, there has not been any noticeable loss of market share in the search engine market. So for Google, so interesting stuff.
Okay, so the next attribute is pricing power. And these are companies with a demonstrated history of raising prices above the rate of inflation. They have upside value in core products or service for future price increases. They can raise prices with little or no pushback from their customers. Yeah, I think I may have misunderstood. I thought this was the most important, but again, the way he's got them listed, he has them listed in order of importance, actually.
We'll just change it to an important, not the most important. There we go. Go ahead.
Important. Oh, okay. Sorry. Go back a slide there. So yeah, the examples that he has for companies with pricing power would be Visa and MasterCard, as both companies has very few competitors, and customers are willing to pay higher prices for their services.
Absolutely. In fact, I experienced the Visa MasterCard thing from the business owner side, and they are, in a word, formidable.
Yeah. All right. So operating leverage, and this is with respect to the business model of a company. Essentially, each incremental dollar of revenue increases margins, and they tend to have a long runway of a large total addressable market to scale into. So if you go to the next slide, we'll look at some examples.
Yeah,
So again, MasterCard, they have a lot of fixed costs to run the initial business. However, they also have a lot of variable and growing revenue, which creates operating leverage in the life of the business. Another example he gave was Netflix. They have an enormous amount of fixed costs. So for the content that they have out there, they're going to spend about 16 to 17 billion a year to create new content that goes on the site. However, their revenue is rather variable from year to year. So if you look at the history of their operating margins, you'll notice that they tend to go up over time.
Yeah, this one I find most interesting, and I want to kind of put a little bit of bookmark out there for everybody. As I watched his 20 or 25-minute introduction to these themes, he talked briefly about this operating leverage, which is really just looking at the characteristic and the trends for the profitability of the business. You might think of it, go back to the work that we did years ago with Mercado Libre down in South America and Latin America. And we talked a lot about the scalability that as the dollars kept coming in, the amount of profit that they made on each incremental dollar was going to go up over time. That has certainly come to pass. And he spends just a brief moment. That's why I want to go back and search back through some of his stuff. We'll probably compare notes offline, Ken, a little bit. He talked briefly about, he didn't name them specifically, but we've talked about it here in the past. The Morningstar and the Value Line, and frankly, most of us, if not all of us, struggle with the increasing profitability of companies over time as we're trying to build our visions of the future business for a company. And it's probably one of the tougher aspects of any stock study that we do. And the work that we did with Church and Dwight a little while back, we'll come back to that and talk about it. But he actually points out this is why Morningstar and Value Line get so messed up with an NVIDIA. He doesn't mention NVIDIA, he doesn't mention the companies, but that's what he's talking about, how challenging that can be. So again, we'll bookmark it. We want to come back to this topic specifically, and hopefully we can find some stuff that we can lean on from Mr. Carlson.
He really did stress that operating leverage is really hard for a lot of analysts to assess.
Yeah,
so
definitely.
All right, so the next attribute is organic growth. So these are companies that don't rely on acquisitions for growth. They tend to grow by price and volume increases. They build or develop products or services internally. And his examples here are Chipotle and Texas Roadhouse. Both these companies grow by increasing their prices and adding additional store locations. But yeah, I believe these are definitely companies that tend to compound their value from year to year.
Yeah, and just to underscore again, Chipotle is one that has scared many of us off. First of all, many of us are afraid of retail restaurants anyhow, but Chipotle was really tough to get our arms around over the years. Counter to that is Texas Roadhouse, which has been pretty easy to track and very consistent. And in fact, it's a round table company for many years now. So again, an opportunity for us to look closer at this issue of a tiger by the tail in the name of Chipotle and understanding it going forward.
So the next attribute is capital light, and these are companies with low amounts of fixed costs and low research and development and capex relative to revenue. And he didn't really talk about a lot of examples here, so I kind of researched it on my own. And I did find an article, and this is kind of some of the examples that I gathered from the article, which I do have referenced in the resources. Next slide. So, of course, MasterCard was on that list. It's a global payments company that facilitates seamless and secure transactions connecting consumers and businesses and governments worldwide. And then another interesting example was Meta. It's a trailblazer in social media and technology, formerly known as Facebook, and it provides an array of digital products and services. So you could also think of, Uber and Lyft. They don't necessarily own the vehicles that provide the transportation service, but just as well, they're able to provide that service through different car owners sharing their vehicles. Any
Okay.
comments here?
No, other than I would agree. I mean, Uber's a great example.
We do have a question. Bill Warner asks, how does Netflix fit into low capital and fixed expense? And I know in Joseph's video he talks about that, but I don't know if you guys want to talk about that for a minute.
Well, I'm not familiar with the exact debt characteristics of Netflix, but I suspect it's pretty attractive. I mean, their cash flow is so large compared to any interest payments that they might have. But we could take a closer look at that. Any thoughts on that, Ken?
Not so much as an example of a capital light, but no, I don't have any thoughts with respect to capital light for Netflix.
I think in Joseph's presentation, when he talked about him, he specifically cited what's often cited in a lot of streamers is how much they spend on content. And Netflix was spending $13 billion on content, which is no small amount, but adding the 251st million customers adds zero to that content. You still have to distribute to them, and there's some networking behind the scenes. But I think in his mind, the key leverage there was once the content's made, you can distribute it to the next person for next to nothing.
Exactly. Yeah.
Okay.
All right.
And then we have smart capital allocation. These are companies that spend their cash on buybacks, dividends, and you mentioned tuck-in acquisitions. And these tuck-in acquisitions are buying small businesses that benefit the core business. And I did some research on that, and I found an interesting article, again, that I also include in the resources. But also, these are companies that where capital allocation makes or breaks, he says capital allocation makes or breaks great companies. So if we go to the next slide, I'll review the examples there.
Sure. Just a quick comment before we go. I think this is a space for another bookmark. I've heard from a couple of people since Warren Buffett came out with his Berkshire Hathaway letter to the shareholders this past weekend. Buffett spends some time talking about buybacks and how to basically watch for them and make sure that they're doing it wisely. Now I'm paraphrasing, but it might be interesting to take Carlson's commentary here and blend it with what Buffett had to say and basically put it in our language, because capital allocation is one of the bigger components of success for companies like this. So go ahead.
Yeah, I'd have to say, Mark, to throw in another restaurant, because they can be good. Panera Bread. I owned Panera Bread for a number of years.
Yes.
up till they sold out. And that was one of the most impressive things about that management group. They were very relentless. They had a program for stock buybacks, and they needed a 15% hurdle rate on it, bar none. And they said if they're, if they had one pool of capital, and if it was better to develop restaurants, they would do that. If it's better to buy back franchisees, they do that. And then if the best thing to do was to buy back stock, they would focus on that too. And there are many quarters and many questions from analysts in their earnings calls about why aren't you buying stock back? And they would simply go and say, it didn't meet the hurdle rate. The absolute discipline on it made them very easy to own.
Yeah, and that's an attribute that can be a bit fugitive in companies. So, and I'm sugarcoating.
Sandy Castor is commenting that Buffalo Wild Wings was the same way.
Yeah, I would agree.
So with respect to tuck-in acquisition examples, of course we have Microsoft. They have flagship products, which are Windows and Office. However, they have acquired, add-on services, Hotmail, provide email service, Skype, and then Nokia's hardware division. I'm not as familiar with that acquisition of what that brought to Microsoft. Maybe you all are more familiar with that.
I'm not, but I think I need to be.
Yeah, I don't think that generally worked out, but it was something they did, right? For a while there was a Windows Phone that my company actually used it because we were looking to leverage the corporate infrastructure, Windows infrastructure there, but that fizzled out after not too long. I don't know if there's anything more permanent from that they came out with.
Could be interesting.
And of course,
Go ahead, Ken.
Well, and then of course we have Apple. They acquired Siri, which gave them voice recognition services. I believe they bought Beats, which provided them with audio products. And then they bought an interesting service called Shazam, which had provided them with music and image recognition. So they've incorporated that into their ecosystem. All right, so yeah, there are 4 unattractive attributes, and that was to be the nature of my part 2.
Okay.
For my club. So
we'll get you back. We'll get you back for part 2 after you have your next model club meeting.
Gotcha.
Okay. Any other questions from the audience, or any thoughts here that you'd like to share?
Len's commenting that if you go all the way back, Microsoft didn't originate DOS; they bought it. It was originally as a supply agreement to IBM, and IBM didn't want to run it, so they sort of gave it away or gave the rights away. So even Microsoft's very early days was, I wouldn't say it's a tuck-in acquisition. That's probably an origin story. But I was poking around. There were a number of Office components they did. So through their whole life, they've done tuck-in acquisitions for sure.
Absolutely. And Kim had a thought. I heard Kim.
Yeah, I was going to say that another stock to consider is Wyndham Hotels. You think that would be very asset heavy, but it's asset light. They just own, they do all the back work for all the franchisees. They don't own the hotels. They just help do all the reservations and help buy all the supplies and all that. So that's another asset light business that's done well. And I think now they're number 1 with the number of hotel rooms worldwide.
Interesting. Well, it'll be fun to dig in a little bit deeper to this, because he's obviously going to avoid electric utilities or companies that are capital intensive. And in fact, he makes a point about avoiding some of the pharma companies that we follow. So there's more to dig into here, Ken, and we appreciate it.
So you have a list of the resources. So I have a link to the show where he discusses these compounding machines, and then the couple articles I found on both on tuck-in acquisitions and then capital light businesses. So those are there for your Over to you.
Right, and it'll be, all of these are active links in the manifest forum under this particular session. So I would encourage everybody to have some fun and think about where this stuff applies. And we are going to have some serious fun taking a look at the companies that Mr. Carlson tracks and follows. All right, any other closing thoughts, Ken?
Oh, thank you for allowing me to come on and share
Oh,
this. This was fun.
it's our pleasure. Thank you for the contribution and the awareness of Mr. Carlson. He's not going to have to find out how old he is, because he's certainly not Warren Buffett age, probably about a third of
Still a
Warren.
lot of compounding to go, probably.
Yeah, a lot of compounding to go for Mr. Carlson. So some good stuff for us to take a look at. All right, I wanted to do a little bit of follow up. This is basically inspired by those of you that write to me. When I hear from a handful of people, I know that it's something that you guys want. This is another Carlson, the other Carlson, Ben Carlson. We talked about his article, Stock Picking is Not the Same as Portfolio Management, last week. He asks a lot of the same type of questions that investors ask themselves and others, and on the left-hand column there. And then we talked about how we do think we've got a fairly well-defined selling discipline. And by the way, it lines up pretty well with Joe Carlson's, as he talks about it in some of the references that Ken Williams has provided. And I just thought I would make the point that, again, the most powerful thing that you can do when it comes to selling stocks that you own is to evaluate, where they're at in your portfolio, and are they doing what you need them to do in their role in the portfolio? We believe that sorting by the return forecast, the projected annual return on the far right of the portfolio here. I just grabbed an old portfolio. This was probably from a presentation in Chicago many years ago. We named it the Ditka Dozen, and I hadn't taken a look at it in years. And you just see that this PRA group not performing very well. And it has been years since we took a look, so I thought I would just use it as a quick example. Again, sorting from top to bottom on the return forecast, you're basically looking at purchase candidates at the top, selling candidates at the bottom when you sort it from highest to lowest return forecast. So in this case, I think PRA group is again, it's probably out the door. That original $100 is probably down to 50. The quality has sagged to 8, so it actually would qualify at a different point on here. But we think we can improve this portfolio by dumping some of that and going out and finding some better candidates. So challenge the weakest ones. Then again, individual holdings within a portfolio, even if the portfolio doesn't need it, if it's a core holding, if you're basically at or near money market rates, or as we would argue, if you've got a really strong core holding, you want to give it a lot of room to run. And as Nicholson has always told us, that if you've got a company, NVIDIA comes to mind, anytime they've got that huge double-digit line growth rate, time heals all wounds, according to David L. Babson, give that one a whole lot of room to run. If it is non-core, maybe you sell it at a return forecast in the neighborhood of the average or median market return forecast. And not even that is automatic, but at least gives you something to think about. In this case, everybody here is above money market rates for sure, and only a couple of them are in that market average range. The third one, sell if the quality's dipping. We'll talk a little bit more about that in a minute. We'll come back and talk about this MFI or RSI in the future, but then we also have this notion here of going ahead and being willing to sell a company. This one's been dramatically successful, Mercado Libre. And for a company or a portfolio of 10-ish stocks, you would really want to give selling consideration anytime that gets above 20 or so. So again, we run into companies with Apple or companies like Apple, Microsoft, in some cases NVIDIA now, where you do want to be in a position to be watching for selling opportunities to trim those positions. You don't have to get carried away. This is not an emergency. You don't have to run for the exits right away, but you might want to watch for the opportunities to trim those positions. This one could be argued is pretty far out of control, so we did actually reduce the size of that position in this exercise. So again, using those selling rules, you can use the worksheets that manifest to do what if games. So here we'll be taking care of getting rid of PRA group. Did a quick stock screen looking for companies with sufficient return forecasts. So 18 to 22%, as you see here, with excellent quality. Didn't want to go too low on growth. And you'll notice that I left the discretionary sector out of this one. I think we had the picture. We didn't want any more of this by any chance. We're going to reduce the size of that position as we get rid of a little bit of Mercado Libre, but we didn't want to add to it. So we left that off as a sector. Came up with 5 pretty decent names: Lantheus or Radimed, Dr. Pepper, Keurig Dr. Pepper, a bank which has been named by a few people in their groundhog portfolios, Farmers and Merchants, and a company we added to the Buttonwood portfolio recently, EXL Service Holdings. So we add those 5 and actually called an audible in honor of Kevin Gologly and through Western Alliance in there instead of Farmers Merchants. Just simply added them in there so we could take a look at their quality and return characteristics. You can see there's no shares here. We're playing what if games here with the portfolio. You can see that PRA group has been sent to purgatory for sale and actually reduced the size of the Mercado Libre position, selling a good piece of it to generate the cash that's shown here. And again, we just basically said, what if you added $300 of those 4 positions? I left Lantheus off the list, spread out our $1,200 amongst these 4. And again, this is just demonstrating what you can do. And you can see that the discretionary is now a much smaller slice. We've distributed the holdings amongst a number of sectors, but most importantly, we were dealing with a portfolio that had a return forecast of 6.8%. And with these, basically it's 6 transactions, we raised it to 13.8. Not completely where we want to be, but certainly a step in the right direction. The quality of the portfolio went from 59 to 76. Again, a very nice move. And we did all of that with a growth rate of 13.8, now at 13.6. So we did not ruin that. And then there's just a couple other things. The PE ratio of the companies in the portfolio is 25 instead of 34. A little more financial strength and a little more predictability. So again, this is just an example of how looking at the portfolio itself, it'll tell you what is needed. So again, kind of walking through those rules that are right there in the yellow shaded area. Now, the one that we're going to work on a little bit here over the next few months is this one. Not quite sure yet how we're going to look at it and how to flag the situation, but this is one we have scratched our head about over the last couple of years. And this is not a subjective measure. It's basically a calculation. Anytime you see the quality of a company like Intel declining like this, that means versus its peers and competitors, its balance sheet is weakening perhaps in some way, or the growth rate is slowing down versus the industry, or the profitability is weakening versus the industry, or perhaps the earnings are just getting less stable. So, I mean, there's something really happening there. So, again, what we want to try to flag as a potential reason to consider a sale of a company is some type of a quality deterioration. And we'll be digging a little bit deeper into that. I think we want to be a little more definitive than we know it when we see it, because I don't think that's true. Any thoughts on that, Mr. Spielman or Kim or Ken?
No, I agree. You had mentioned I'm a fan of Adobe. I remember I brought it back last. It had just missed a trip to the woodshed the month before, which I didn't know, honestly, because I was on summer vacation. So I innocently walked in saying, I think this is underbought, and I walked in the middle of the conversation. So I think Ken had talked about worrying about RSI in particular, but in a increasing market versus a declining market, which was in 22, fall of 22 that was. Certainly Intel is a great one. Intel is something that the Houston Model Club, which I'm president of now, but we wrote that down for a while. Tax loss harvested it, said we'll check in back again, and of course, like so many of those, you never do. So I think that's tough on the way down, and it's tough to learn the lesson and see if it's something to keep on a pounce list or trust again at some point.
Yeah, and then one of the major mistakes of my investing lifetime was averaging down into a company where the quality was falling off the cliff. And I'm not going to go deep into the story. One, it's too painful. One, I don't have time. But yeah, it's the type of thing that we want to get a better handle of. I think that our measure of quality characteristics over time is fairly unemotional, something that Carlson talks about a lot. You'll probably hear more about that from Ken Williams in part 2, trying to keep the emotions out of it and see what we can do. But that is work to be done. So hopefully that gives you guys a little bit more example of some of the selling criteria that we adhere to and attempt to follow. Here's a look at the Buttonwood Bulls Club dashboard. By the time we meet next, another $100 will have flowed into the portfolio. We have an automatic contribution to the real money portfolio, and you can see from top to bottom, not doing too badly. We added Thermo Fisher, one of Joseph Carlson's favorites, to the portfolio 2 weeks ago. And again, looking at the portfolio in general, decent growth rate, excellent quality. This will get higher as we add a few more companies and have a little bit less cash, and we will be converting our starter position in this particular exchange traded fund, 3 shares of VUG. We just put that there as a placeholder. We eventually will end up with approximately 16 companies that we will use these techniques and tools to take care of. And I suspect we will be spending considerable time looking for Joseph Carlson type companies going forward. Any comments or thoughts, gang? Or are we good to go? We are running up against 3 o'clock.
We are. There's a couple of very good questions still from Ken's presentation, but given the time we're at, I also think it will be very instructive. It's always instructive for me to see the counter examples, right? It's always easier to see a rule when you see where the rule is broken, not just where it's made, and then maybe it's right. I'll say, where is it? Kim's comment on Wyndham brought up some interest in, well, where are the other Wyndhams of the world? But maybe once we get through what it shouldn't be, then we can talk about where other ones are.
Okay. All right, here's a reminder that we do archive all of these sessions on YouTube under the Manifest Investing channel. That includes bull sessions and roundtables and special educational sessions. Subscribe if you'd like to be notified anytime that new content is added. Here's a reminder that we will be handing out the Golden Knight statuettes a week from today. I had a good year last year, and I probably won't have quite as good a year this year, but there's a reminder. Kim mentioned it earlier. We've been doing this for a while now, coming up on our 14th year, and our annualized rate of return stands at 17.6. That's pretty favorable to a market trading at less than 12%. The actual date is March 5th, next Tuesday, 8:30 p.m. Eastern Time. This one we do tend to open up the red carpet / green room a little bit early. Yes, you can come in your jammies and bring your own favorite beverages. Just a quick summary of stuff at Manifest Investing. In fact, if you want to share, just give some ideas of some of the stuff that we do. And I think that's all we have for today. We did promise to cover Neogen next week, along with a couple other comments in the mailbag. If you have a question from today's presentation or a question in general, let it fly, and we will tackle some of these next week. Always fun. Remote control for the TV. And so with that, anything else in the hopper, Matt?
No, good. Just some thanks. Thank you, Ken, for the presentation. It was great material. If anyone wants to go down the rabbit hole, the linked video is 45 minutes. I can't guarantee you won't be curious enough not to find a few more.
I would virtually guarantee you that you will lose more than 45 minutes if you start down that rabbit hole. And it's a good rabbit hole. So we will be spending more time with Joseph Carlson, and even more importantly, a little more time with Ken Williams in the future. Thank you so much, Ken.
Thank you so much for inviting me.
All right. Take care, everybody out there. Get out there and find the opportunities and let us know about them. Again, our roundtable is next week, not tonight, next week, 1 week from today. So good hunting out there, everybody. Take care.